hey, you do you. I like big data. No, nope, yes, yes. And remember, I'm saying no and yes. This is for me. You can do whatever the hell you want. Listen, I already made my money, man. I just want you guys to be smarter so that you make your money. And then if we have smarter investors, we have less dumb investors. We need to raise the investment IQ. Render. It's a spammy, cool, propaganda-y, kind of like blingy. We'll go talk about it-y, social media-y, kind of. It's a cool company, but it's got too many douchebags involved. They're C-class executive to douchebag count, that proportion, it's way out of whack. Ocean is a yes. Seems to be holding up pretty well. Again, this is distributed data. Privacy token, AGIX, holding up pretty well. I mean, considering it's still up 344% on the year, you still made great on this. And there will be HyperCycle rewards coming. They're not yet, nothing's been announced, but they're developing that program. For AGIX holders, you will get rewards in the form of HyperCycle, which you'll be able to stake and participate in tilling and AI compute and make currency units. There will be something with Rejuve and something with Cogito, but there's no way to know because those teams are so backwards that they can't find their ass with two hands. So just wait on those. But Singularity Net team themselves, they are moving forward. Also, as a note, Singularity DAO, they're about to launch their next version of what's going on there. I don't think you own the token yet, but I think it's not too long before it might make sense. So we'll have to see what this version 2 looks like. Rejuve is a hard pass for me unless you're using staking rewards to get it. NewNet is a yes for me. I like it under 5 cents, but you do you. I'm not telling anyone to do anything. HyperCycle, I mean, it's juicy and delicious. And Cogito so far is a big fat flop. We don't need to launch on Ethereum. We'll just launch on Binance because shut up. Okay, let's talk HyperCycle for a second. For those of you that might be in any of these groups, there could be some potential. I put it on a thing. I know it's hard to read, but you know what? You don't need to read it. I'll read it to you, and then we'll move on to inflation. Okay, what do we say? So these are the HyperCycle kind of partners. Data centers and cloud providers. These businesses already possess significant computational resources. HyperCycle could provide them with additional revenue stream by monetizing idle computation power through AI computation. Meaning, you've got 10 computers or 100 or 1,000. They're not all running all the time, or servers. They're not all running all the time. So some of them might not be. You might be not at full capacity. Take some of that compute, take some of that and redirect it towards processing AI transactions, and you monetize that computational power. And the rough estimates right now in the very worst cost, which is I think Copenhagen, which is where electricity is the most expensive, it's a 3x of your electrical spend. So if you spend $1 a month on electricity, this would return $3. Okay, and that's in the very worst electrical cost scheme. Anyway, second group is AI and machine learning companies. Firms that heavily rely on artificial intelligence and machine learning could benefit from HyperCycle's Layer 0 blockchain architecture, both from an operational standpoint, for their own AI computation, and then from a financial perspective of monetizing excess computation power. You're going to see this over and over. Don't have excess computational power or power in general that you're not utilizing. Turn it into currency units. God, man, especially in a deflationary environment where your dollar goes further. Okay, cryptocurrency miners. Cryptocurrency miners, this is a tricky one because a lot of people are like, no, I'm going to mine Ethereum and make $4 a day when I could be making 600. Why? Because Ethereum. Why? When people don't want to answer why and they'd rather lose money, don't be in business with them. Anyway, cryptocurrency miners. Cryptocurrency miners with powerful computation infrastructure might be interested in diversifying their activities and revenue streams by participating in AI computation. Okay. Research institutions and universities, they often have huge infrastructure. These organizations often have high performance computational resources for research purposes, meaning crap ton of computers. They might be interested in HyperCycle to fund their research activities by monetizing unused computational power. You see a recurring theme here? You got extra, turn it into money. Enterprises with in-house data processing. Many large businesses have significant computational resources for data processing and analysis. They could be interested in HyperCycle to offset their operational costs by monetizing excess computational capacity. Blockchain and distributed ledger companies. These businesses could benefit from using HyperCycle as part of their infrastructure, especially those focusing on decentralized applications, dApps, fintech or DeFi, decentralized finance, which often require substantial computational resources. So you could leverage this ledgerless system, basically just clean up the mess. Less friction means more money in your pocket. Gaming companies with powerful servers could monetize their off-peak resources by running HyperCycle software and monetizing their compute resources. IoT companies, as the Internet of Things, this is IoT for those of you that are curious, expand, companies with a vast array of connected devices could leverage these devices, collective computational power via HyperCycle. Startups in need of high-performance computing, startups in sectors like biotech, financial modeling, climate stimulation, etc., that need HyperCycle but cannot afford to build their own infrastructure may find HyperCycle's solution attractive. When, a startup, a lot of times, startups are all different. Hence, the startup culture, which is, it's relatively unpredictable. Well, when you're starting up, one of the hardest things, many cases, is to ramp up your infrastructure. You just may not own all of the compute that you need or all of the resources to do this kind of high bandwidth, high throughput computing. Well, you have this infrastructure that HyperCycle already has. You can leverage HyperCycle and use it to manage and run compute at a much lower cost. Governmental agencies looking to efficiently utilize their computational resources might be interested in HyperCycle to support their public services or research efforts. I was reading about a library. Some of these big libraries have tons of compute and it just never gets used. It just sits there idle. A couple times people will look up a book or do like a little research. But for the most part, this crap sits idle all night long, like 12 hours a day, idle. That could be making money. And if they're making money, then they're not taxing you out your a-hole every chance they get, especially for those of you that live in areas where the municipalities will take those public services and they'll just hammer you with property taxes and more property taxes and more, the lever that always goes up. Anyway, interesting to think about, is it not? Okay, so if you fall in any of those groups and you think, hey, I know this or that, and I can find somebody to do or whatever, and you want to make currency units off of this stuff, then shoot me an email and I will redirect you, or I'll even step out of the equation. I'll do you a solid. I'm going to put the name here. I'll put it in a little banner. Let me make a banner for you all right now. Here is my banner. Give me a second. I'm going to make a banner. This is the here is the email of the person you should reach out to. Nara at hypercycle.ai, just like it's N-A-R-A at hypercycle.ai. If you think you fall into any of these groups and you want to make money units, currency units, by helping, participating, linking up, whatever, there you go. I don't, listen, my name's Bennett and I ain't in it, although I am in it because I have a bunch of tokens and I support the network. But I like the idea that, regular people can get paid to participate, because whatever the future of AI looks like, you might as well monetize that. You might as well get a piece of it. Anyway, this is just my idea about that. Okay, We have to move on now. We have to go talk about, and these are my opinions, we got to talk about interest rates and how everything you think you know, everything you think might just be wrong.
Yeah, well, you know, that's just like your opinion, man.
Okay. We got some myth exposition here. Oh, it's not exposition, exposing. The jury is out on a lot of this stuff. Why? Because all of this stuff is lagging, meaning you make adjustments to monetary policy and maybe you see some results from it, but they're so far down the road that you don't know if what you did made the difference or if you just did stuff until there was a difference, right? Like monetary policy, in my opinion, is a lot like sitting at a stoplight. It matters very little what meddling you do at the stoplight. It will eventually, if it's green, it will turn yellow and then red. If it's yellow, it will turn red and then green. If it's yellow, it will turn red and then green and then yellow again and then red. Like these are cycles. Cycles are normal. You don't get to take credit for the light changing by sitting at the light. And this is what the Fed does. They sit at the light when it's yellow and they tell everyone, now that it's yellow, we're going to slow things down. We can't have things being too green or too red. So we're gonna slow things down. Matter of fact, we're gonna force a red light. You ain't forcing nothing. You didn't force anything. It's these things happen. So the problem with monetary policy is everybody can take credit. Everyone can sit at a stoplight and take credit for the lights changing. When it's red, everybody can say, we made it green. You didn't make it green. It's on a timer, you dummy. So this is just, it is what it is. Most of it's myth, whimsy, legend, propaganda, bull smoke. Even Bernanke said it, man. 98% propaganda, 2% efficacy. Go look it up. Anyway, everything you think about interest rates might be wrong. The relationship between interest rates and inflation is, arguably a complex one. And there are differing views on how raising interest rates might affect inflation in a country. Here's part of the story. According to the traditional view of monetary policy, and again, I caveat that, the traditional view, people that went to school in 1960, telling you how the world works right now. So just asterisk, all right? The idea is raising interest rates is often used by central banks to control inflation, right? When interest rates increase, borrowing becomes more expensive and can reduce spending and investment. This decrease in spending and investment can in turn lead to lower demand for goods and services, right? Okay, so if the decrease in demand is significant, businesses may respond by reducing prices, because businesses always reduce prices, right? They put more Doritos in the bag. You guys remember that, right? Oh, wait. Anyway, businesses may respond to this by reducing prices to stimulate sales, leading to lower inflation. Additionally, higher interest rates can attract foreign investment, increasing the value of the local currency and potentially reducing the price of imported goods, which can contribute to lower inflation. Well, that's interesting. However, there is an alternative view, a few of them actually. One of them is known as the neo-Fischerian perspective, which suggests that raising interest rates could have the opposite effect on inflation. This is where you got to dig into the math a little bit. But proponents of this view argue that higher interest rates can actually increase inflation expectations and subsequently increase inflation itself, right? The neo-Fischerian theory, we'll call it new fish. The new fish theory posits that higher interest rates may lead to higher expectations of future inflation. As individuals anticipate that borrowing costs will continue to rise, these expectations can influence consumer behavior, causing people to spend and invest more, creating higher demand for goods and services. This increase in demand, in turn, may push prices higher, resulting in inflation. This is the idea that if you think it's coming, you make it happen. But that's also partly theater, isn't it? So it's worth noting that the relationship between interest rates and inflation is not universally agreed upon, not at all. And economists, be careful when you're talking to an economist. I would rather be talking to a game theorist. But anyway, most economists have this ongoing debate about the effectiveness or efficacy of monetary policy in managing inflation. And even many of the old school Keynesians, they don't necessarily buy into the idea that the Fed has any ability to do any of this. Well, remember, the Fed's not really a central bank, is it? They don't deal in money, and that's a problem. If you're trying to have monetary prowess, monetary efficacy, right? Don't you need money? Like, how can you have monetary tools that are non-monetary? What is your tool for fighting inflation? Monopoly money. What? Anyway, economic conditions, market dynamics, various other factors can influence the outcomes of interest rate adjustments. So let's look at a slight derivative contrarian view. And again, it doesn't matter where it comes from. This particular one comes from Warren Mosler. He's an economist known for his contributions to another very intensely argued thing called modern monetary theory, or MMT, which, listen, no one's got it right. They are certainly nowhere close. But he does have a very unique viewpoint regarding the relationship between raising the inflation rate and its inflationary impact. So according to Mosler, according to his MMT ideas, increasing the inflation rate itself is inflationary. And there is, and again, this isn't about MMT because this is just a tiny, tiny part, but this may make more sense based on math. Okay. So essentially, his perspective stems from the belief that inflation is fundamentally driven by the availability of goods and services in the economy rather than changes in interest rates or monetary policy that affects a couple dozen banks and no one else, right? So, and you might say, yeah, I mean, I guess that kind of makes sense. Mosler argues that inflation occurs when the demand for goods and services exceeds the available supply, right? If there's 10 eggs and there's 10 of us, we each get an egg. If there's 10 eggs and 20 of us, it might get dicey. We might be fighting for those eggs, right? So in line with this thinking, he suggests that raising the inflation rate, typically done by central banks to combat deflation or to stimulate economic growth, can lead to increased spending and investment. As a result, the aggregate demand, the overall demand rises, potentially surpassing the capacity of the economy to produce goods and services. Remember, now there's more people fighting for those same amount of eggs. They can't up the egg supply as fast as the demand increases, right? So aggregate demand rises, surpassing the capacity of the economy to produce more of those eggs. This imbalance between demand and supply can push prices higher, causing inflation. His viewpoint challenges the conventional understanding that higher inflation rates are solely a consequence of excessive monetary growth or loose monetary policy. If the supply of actual money in the economy grows, we see inflationary effects. But it's these weird times where we see price effects that are not so clearly monetary that everybody goes, oh crap, man, what's going on? And this is where people start arguing. This is where all these armchair erudite armchair sophisticates start doing battle, right? So anyway, Mosley suggests that it is the increase in demand resulting from a higher inflation rate that contributes to inflationary pressure. The idea that rate hikes are inflationary is a rather straightforward one, right? So you think, okay, interest rates rise, the Fed pays out more interest on bank reserves, which means they print more money. So think about that for a second. If you raise the interest rate, all that debt that's getting sold to whoever it ends up in, whether it's money markets, pension funds, hedge funds, wherever those bills go, wherever those bills, notes, or bonds go, if you raise the interest rate, then the government has to pay more interest on that, meaning they have to print money somewhere at some point, and not funny money, actual money. It's got to come from somewhere when these guys redeem. So printing money, if you think about it, is probably a very weird way to fight inflation. But if we go to Powell and say, Powell, what are you doing? We're raising the rate to fight inflation, but you're going to pay out more money. No, that part doesn't count. The part that counts is the part where banks reduce lending. What? How? What are you talking about? Anyway, higher rates also mean the Treasury pays more on the debt it issues, which increases deficit spending, right? So now the government's spending more. The federal government is likely to spend at least $1 trillion on interest this year. $1 trillion. All of it, either printed or borrowed. Well, obviously printed, borrowed against our future prosperity, ergo tax. It is, of course, possible that these interest payments are inflationary because, if you're raising interest rates and you're creating money out of thin air and you're creating debt out of thin air and you're selling that debt and you're paying interest on that debt, at some point you have to pay interest on that debt. So it does make sense what he's saying. Again, you don't buy into all of his, he's like a lot of these individuals, they are very interesting to listen to. And sometimes they'll go off into whimsy, but it is possible that interest rate payments are inflationary. Second order effects of rate hikes make them potentially net deflationary, as everyone else says. You can have it. It could be both, right? And so the reality is you have all these weird factors in the economy that are all kind of fighting, inducing it out. There is no one obvious. Well, there's a few takeaways from this, but anyway, let me go on. The Fed's hikes so far have imposed something like $1 trillion of mark-to-market losses on banks, which does discourage lending. But is that the Fed is discouraging lending, or is that the economy is discouraging lending? Remember, if the Fed is trying to save the economy, then you have the presumption that the economy is already in a weak position. Well, if the economy is already in a weak position, then it's the economic cycle, the situation, and the place we're at the red light, and now we're in the yellow. Well, so we slow down. Some people push through the yellow light and risk a wreck. Some people slow down. You guys know that you're not supposed to enter. If it's yellow, it doesn't mean speed up. If you're not supposed to enter the intersection at a yellow, you're supposed to dial it down. It's if you get stuck, that gives you some time to not die. Most people, I don't know if they get that. Anyway, so the idea is, if you're at a yellow light, there's already some problem, right? So if banks at a yellow light start pulling back on lending, it's because they don't believe they can make money lending. It doesn't have anything to do with the Fed because, in the Fed's own words, we're now here to help get through this yellow light to the red light, or we're trying to go back to green. So it doesn't kind of gel what they're saying in the first place. Anyway, higher interest rates might, in theory, lower the velocity of money by encouraging us to park our savings in money market fund instead of, say, investing in risky assets. It's important to note that Mosler's perspective is not it's not universally accepted among economists. It's quite the opposite, actually. And there are various theories and models explaining the causes of inflation, and the Fed and most of these central bankers and economists in general, they like to use this very reduced, very simpletons, like borderline, like 23rd triploid, like kind of idea of, Phillips curve is all you need. Inflation on one side, unemployment on the other. Everything else doesn't matter. We can just stare at this chart and we can manage an entire economy because it's that simple, which is really not who I want at the helm. Anyway, the relationship between inflation and economic variables remains this kind of ongoing debate in the field of economics. Now, do Jerome and the idiots have it right, or are they behind the curtain kind of like trembling? It is likely, very likely, that they are afraid that if you think too hard about the math in this situation, you'll stop believing the myth. You'll lose faith. You would lose faith in the Fed's magical ability to slow down the economy, which might therefore end the Fed's ability to slow down the economy. Meaning, like Bernanke said, 98% theater, 2% efficacy. So if the only idiot at the Fed that anybody respects, and for whatever reason people respect Ben Bernanke, I can't figure it out, but he's the only one that people look like he basically conjured up his own Nobel Prize for being so wrong about subprime that it tanked the world economy. So but by all means, he should definitely get a Nobel Prize for that behavior. So you start thinking, man, if it's all theater and you stop believing the theater, and the theater, what was, so for instance, the Fed says we're going to slow down the economy, and you believe, like a jackwagon, that works. Okay, cool. But if you stop believing, or if you like do math and you have like, a phone or napkin and a pencil or even a crayon, and you go, wait a minute, if we raise rates, we pay more interest. We pay more interest. We have to create that money. That's inflation. That's a kind of like transitionary, kind of a weird stimulus-y, here, participate in my fraud and we will hook you up kind of a scheme. That looks really inflationary. It certainly doesn't look deflationary. So if you stop believing the myth, the whole thing grinds to a halt. So, and this would be a problem, obviously, as the second order effects of rate hikes are mostly about propaganda, about us listening to the Fed, to Jerome, to the idiots. And remember when Yellen said no more, there'll never be another recession? What? Like it's mind-boggling what these sophisticated erudite types will come up with. Anyway, academics. The Fed says they're going to slow the economy. So we invest less and save more because we think that the Fed is going to slow the economy, which causes the economy to slow as promised. The only thing that we know for certain is that the trading of, and this is the other side of monetary policy. Remember, there's interest rate hikes, which is like a little bullwhip, right? Interest rate hikes or drops, which we now have to question their efficacy or whether they're completely wrong about it. Their other tool is quantitative easing, which is neither quantitative, nor is it easing, nor is it monetary. And we know this for certain because the trading of illiquid banking coupons does not entice banks to tighten or loosen the currency faucets any more than having a pocket full of monopoly money makes you feel like giving your insolvent Uncle Steve another loan because he knocked up an exotic dancer, right? Like I don't care how much monopoly money you have in your pocket. That doesn't make you go out into the real world and start throwing cash around and giving real money loans. That's what this is. So when you reduce these things to simple math, when you put them on a payoff matrix, like in game theory, they start to look very weak, very weak. And so I would urge you all to sit back and just maybe rethink the way you think about monetary policy. Rethink the way you think about the yield curve, what it means. You say, well, I don't care. I just like crypto. Yeah, that's cool, but that's not enough. The only way the aggregate IQ of this space is going to increase to the point where we're not reliant on that space, those legacy D-bags, the fat, rich, white, elitist douchebags that decide who gets to succeed and decide who fails as they trade quietly, illegally. Oh, wait, it's not illegal because they make their own rules ahead of you and laugh at you. Understand this. Jerome Powell, Janet Yellen, all these self-important creeps, they are laughing at all of us. Oh, those idiots, they don't know what they don't know. Like, you get that, right? The reason we want this to succeed is because these creeps, these fat, rich, white, elitist douchebags that are in the middle of every transaction, that trade illegally and front run against you, that are rich, wealthy off of the inequity that exists, the only way to topple them is by rethinking the bullshit that they push out and going, oh, wait, this is stupid. These guys mean nothing. And once you get that, it's very freeing. And you realize, oh, man, I'm just going to look at where I can amplify my currency units the most. That's why I'm in crypto. If there was somewhere else to be, I'd be there. There isn't, though. This is it. It's AI and crypto and distributed systems and soon to be big data. So anyway, don't take my word for any of this stuff. Do your own deep dives, do your own research, dig a little, and just start asking yourself if the things that you believe are because you really believe them or because you've heard them so many times that you just defer your thought process to these douchebags and you're willing to accept the crap that they feed you and tell you it's like fine cuisine. I would say no. I would say, please do not buy into any of it. All right. Have fun. Stay in school. Digital Heavyweights tomorrow. Same bat time. I would say same bat channel, but it's not. Digital Heavyweights is a private group. We meet 3 times a week. We do all sorts of badass stuff. We're in our game theory kind of educational phase where we're going to be doing game theory examples for the next several weeks. Then we will go back. We'll roll back into cognitive bias. Anyway, stay in school. Don't do drugs. Don't do anything my poor, insolvent drunk, strung out on meth grandmother wouldn't do, which you know is very little. And, relax. Just relax, man. You ain't got to rush nothing. Let it come to you. Let it come to you, Francois.